Right now, Nvidia Corporation is trading exactly at $193.76, pushing up by $7.24 or 3.88% in today's session alone. If you're looking at the board, you see green, you see momentum, and you see a stock that has refused to bow to the gravitational pull that critics have been promising for 18 months. But do not let the headline percentage fool you into thinking this is a simple buy-the-dip victory lap. The reality sitting underneath this price action is far more complex, tension-filled, and indicative of a market that is trying to price in a future that hasn't quite arrived yet. The expectation coming into today was clear: volatility. Investors were bracing for a sell-the-news event following the earnings print, expecting that even a beat-and-raise scenario would result in profit-taking from institutions looking to rebalance their portfolios before the year closes. That was the expectation. The reality is that we are seeing a very specific type of price discovery today, a grinding high-volume absorption of supply, where every time the stock dips toward the $192 level, it is aggressively bid back up. This isn't just retail FOMO. This is a structural repricing of what the company's cash flows will look like in 2026. Let's look closely at the intraday movement shown on the chart, because it tells a story the summary percentages hide. The stock opened significantly higher at $195.95, a gap up that immediately tested the resolve of short-term traders. We saw an immediate rejection at the $196 level, which is shaping up to be a massive psychological resistance wall. The price then flushed down to a low of $192.29 around the mid-morning mark. In a weaker stock, that gap and crap pattern would have triggered a cascade of stop losses, sending the price red. That did not happen here. Instead, buyers stepped in at $192.29 with conviction, stabilizing the asset and pushing it back to the current $193.76 level. This V-shaped intraday recovery is a bullish signal for technical traders because it implies that the liquidity sitting below the market is substantial enough to soak up the selling pressure from early morning profit takers. The expectation for many was that the AI bubble narrative would finally gain traction this quarter. The argument was that hyperscalers like Microsoft, Google, and Amazon would inevitably tap the brakes on capital expenditures, leaving Nvidia with a glut of inventory. Reality has completely dismantled that thesis today. The numbers we are seeing, specifically the reported revenue of $57 billion, up 62% year over year, indicate that we are not in the late stages of a hype cycle, but rather in the middle innings of an infrastructure build-out that is shifting from corporate adoption to sovereign adoption. The market isn't buying Nvidia today because of what it did last quarter. It is buying because the sovereign AI narrative, where nations build their own domestic computing clouds, is adding a layer of demand that is completely insensitive to standard interest rate pressures or consumer recession fears. Now, I want to pause here and address the elephant in the room. There is a very loud, very persistent group of investors who believe this valuation is unsustainable. If you're watching this, you likely fall into one of two camps. You either own the stock and feel like a genius, or you're on the sidelines waiting for the crash so you can enter. Comment below with your current status. Are you holding NVDA through these highs? Or are you sitting in cash waiting for a pullback to the 150s? I want to see where the sentiment actually lies among serious investors. Let's talk about the short side of this trade, because it is critical to understanding why the stock is moving the way it is. Shorting Nvidia has been described as a widowmaker trade for the last 2 years, and today reinforces why. The short interest on NVDA has remained relatively low in percentage terms compared to the float, but in absolute dollar terms, it is massive. When you have a company with a market cap of $4.74 trillion, even a small percentage of short interest represents tens of billions of dollars in bearish bets. What we are seeing today is not necessarily a short squeeze in the traditional GameStop sense, but it is a volatility squeeze. Bears who bought put options expecting a post-earnings crush are seeing their premiums evaporate due to implied volatility crush, or IV crush. As the stock holds steady and grinds higher, market makers who sold those puts are able to unwind their hedges, which creates a natural, buoyant buying pressure underneath the stock. If you're looking at borrowing costs, they remain stable, which suggests that the big institutional bears are not aggressively adding to their short positions here. They're scared. They're seeing the same data we are, that the backlog for the Blackwell chips is extending well into next year, and the transition to the Rubin architecture is already being priced in. However, you must remain vigilant. If you are an active trader, you need to watch the failed-to-deliver data that will come out in the next reporting cycle. Often when a stock defies a macro downtrend or pushes through a resistance level like $196 on high volume, it can be accompanied by a spike in FTDs as market makers struggle to locate shares to satisfy the buying frenzy. If we see FTDs spike, it could signal a temporary top or a mechanical correction is imminent. For now, the cane trade is higher, forcing underinvested fund managers to chase the stock lest they miss their yearly benchmarks. Digging deeper into the valuation, the image shows a PE ratio of 55.21. To the uninitiated, paying 55 times earnings for a hardware company sounds ludicrous. The historical average for semiconductor stocks is often closer to 15 or 20 times. But this is where the expectation versus reality framework is most potent. The expectation is that Nvidia is a hardware company, cyclical and prone to boom and bust inventory gluts. The reality is that Nvidia has successfully transitioned into a full-stack computing platform. When you buy a Blackwell system, you're not just buying a chip. You're buying into the CUDA software ecosystem, the networking, Spectrum-X, and the pre-trained models, NIMs. This recurring software-like revenue stream justifies a multiple expansion that pure hardware companies like Intel or Micron simply cannot command. And furthermore, that PE of 55.21 is a trailing number. If you look at forward estimates based on the guidance provided, projecting significantly higher revenue in the coming quarters, the forward PE compresses rapidly, potentially down to the low 30s or high 20s by the end of fiscal year 2026. In that context, the stock is not expensive. It is arguably fairly valued for its growth rate. This compression is what the bears keep missing. They look at the price going up and assume the stock is getting more expensive. But because earnings are growing faster than the stock price, the valuation is actually getting cheaper or staying flat. Let's pivot to the technicals on the daily chart. The 52-week high is listed at $212.19, and the low is $86.62. Think about that range for a second. The stock has essentially tripled from its lows, yet it is currently about 9% off its all-time highs. This consolidation below the $200 mark is healthy. A stock that goes parabolic without rest is a stock that crashes. Nvidia has spent the last few weeks chopping around, building a base. Today's move to $193.76 puts it back in striking distance of that $200 psychological barrier. If it breaks 196 with volume, the path to 212 is relatively distinct, with very little overhead resistance. But looking at the volume profile, we need to be careful. The market cap is sitting at $4.74 trillion, indicated as 4.74 LC in the data. Moving a ship this size requires immense energy. We need to see institutional flows, block trades, and dark pool prints supporting this move. Retail traders alone cannot sustain a $4 trillion valuation. Watch the volume into the close. If the stock fades back to $192 by 4 p.m., it suggests institutions are using this liquidity to exit. If it closes near the highs of $196, it means they're accumulating for the next leg up. We also need to discuss the broader macroeconomic environment that Nvidia is swimming in. It's November 2025. The interest rate environment has likely stabilized, but capital is still not free. The fact that companies are pouring hundreds of billions of dollars into AI capex despite the cost of capital proves that this is not a discretionary spend. It is an existential one. CEO Jensen Huang has framed this as the next industrial revolution. And while that sounds like marketing fluff, the balance sheets of Nvidia's customers confirm it. They are cutting costs elsewhere, laying off staff in legacy divisions, closing underperforming projects specifically to free up cash to buy Nvidia GPUs. This is a cannibalistic capital cycle where Nvidia eats the budget of every other IT department. There is also a geopolitical angle here that cannot be ignored. The United States government, along with allies in Europe and Asia, is actively subsidizing the construction of domestic AI factories. This is the sovereign AI thesis I mentioned earlier. It de-risks Nvidia's revenue.